One of the most shared stock market investing tips is to diversify your portfolio. Don't put all your eggs in one basket. I'm sure you've heard that one. The finance community is nearly all in agreement that diversification offers benefits that should not be ignored. In the finance course that I teach at university, I spend a whole week lecturing on the risk reducing benefits of portfolio diversification. So, given the benefits of diversifying your portfolio are well known and agreed upon, isn't it surprisingly that arguably the best stock market investor of all time holds a concentrated portfolio? A concentrated portfolio is essentially the opposite of a diversified portfolio. Instead of spreading your money across several stocks, you put a big chunk of your money in one investment. Surprisingly, Warren Buffett has 51% of his Berkshire Hathaway portfolio in Apple stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I've spent hundreds of hours researching Apple stock over the last 5 years, writing dozens of articles and making a multitude of videos. In this video, I'm going to share with you the reasons why I think Warren Buffett is attracted to Apple stock. I'm also going to share why I think Warren Buffett doesn't mind having a concentrated portfolio despite what finance theory suggests. And finally, I'll let you know if you should follow Warren Buffett and buy Apple stock. But let me start with why I think Warren Buffett doesn't mind having a concentrated portfolio. You see, the primary benefit of portfolio diversification is risk reduction. It decreases volatility at the portfolio level. That said, it also requires investors put more money into their less bullish ideas. For instance, let's say you want to buy three stocks: Tesla stock, Amazon stock, and Apple stock. But you think Apple stock or Amazon stock offers the best value out of the three investments by far. According to diversification theory, it suggests you should spread your money evenly between the three investments, regardless if you're more bullish on Amazon. For most investors, diversification would be a prudent recommendation. After all, most investors are not skilled enough to identify excellent risk versus reward opportunities. But that's not true for Warren Buffett. The Oracle of Omaha has decades of experience of outperforming the stock market. So when he thinks one stock, like Apple, offers a much better opportunity than anything else in the market, it makes sense for him to allocate more capital and ignore diversification theory. It's kind of like a don't try this at home type of thing. It works for Warren Buffett because he's one of the greatest investors of all time. So now let me get into why I think Warren Buffett is attracted to Apple stocks, starting with Apple's decades of proven innovation. Apple has the Mac, iPad, iPhone, watch, the new Vision, AirPods, TV and home segment, and entertainment. And interestingly, if you rewind 10 years, most of these categories weren't even available to Apple customers. It had the Mac in 2010, it had iPads around 2010, and it had the iPhone around 2010. But the watch, the Vision, AirPods, the TV and home category, and for the most part, its services segment has grown in the last decade. Before that, remember, Apple's primary product was the iPod. Remember how popular the iPod was? And then that was replaced by the iPhone. And now the iPhone is reaching its maturity, right? Billions of people already have an iPhone. And so Apple is demonstrating that when a certain product or a popular product runs through its cycle and it comes time to introduce new products, Apple has proven it can do that. That proven skill in innovation is undoubtedly one thing that Warren Buffett is attracted to because it demonstrates that Apple can and will make new products that will attract millions, if not billions, of new customers to pay premium prices to Apple. And I can show you here Apple's latest income statement, its financial statement, and you'll notice that the services segment I've highlighted here is growing nicely to 21.2 billion in the 3 months ended July 1. That was up from 19.6 billion in the 3 months ended June 25 of 2022. Now that's offsetting declines in its product category, which fell from 63 billion to 60 billion. But the good news is that the services segment is more profitable than the product segment, nearly twice as profitable as the product segment. So when someone buys a subscription to Apple Music, that's a more profitable sale for Apple than when someone buys one of Apple's hardware products like the Apple Watch or AirPods or the iPhone. And so it's good news for Apple stock investors like Warren Buffett that its services segment is growing robustly to take a greater and greater share of its overall sales. So Apple breaks down its net sales by category, and what you'll notice is the iPhone is struggling of late, dropping in sales year over year down to 39.7 billion, down about 1 billion from the previous quarter a year ago. However, if you look at the first 9 months of its fiscal year, of its current fiscal year, sales of iPhone are down by roughly 6 billion from 162 billion to 156 billion. But that's been offset by an increase of roughly 4 billion in sales of its services, things like iCloud, Apple Music, Apple TV Plus, and so on, which I've already noted is more profitable than the iPhone segment. However, that being said, iPhone is one way that people enter the Apple ecosystem. It's critical that people buy an iPhone because if you buy an iPhone, you're more likely to buy the AirPods, the Apple Watch, Apple Music, Apple TV Plus. It's an entry point to the Apple ecosystem, the most common entry point to the Apple ecosystem. If you look back at the last 5 years, Apple's stock price has increased by 205%. Apple has continued to outperform the market in that time. And so Warren Buffett's investment, or Warren Buffett's portfolio, Berkshire Hathaway's investment in Apple stock, has proven to be a massive success. His portfolio share of 51% in Apple stock has not all come from Warren Buffett purchasing Apple shares. A meaningful percent of it has come from the increase in Apple's price. As the price has increased, it's grown to consist of a larger share of the overall portfolio. Now, whether or not I think you should follow Warren Buffett and buy Apple stock, I like to look at the valuation, and my favorite metric to look at is the forward price to earnings ratio. And right now, Apple stock is trading at a forward PE of 24. In my opinion, this price for Apple stock is neither expensive nor cheap. It's in the range of being fairly valued. So now I would not recommend investors take Warren Buffett's approach and run a concentrated portfolio and put 51% of your portfolio into Apple stock. I would certainly not recommend that. But if you're interested in owning Apple stock, its current valuations are not too expensive for me to say stay away from Apple stock. So if you want to follow Warren Buffett and own Apple stock, that's certainly a reasonable thing to do, but make sure you diversify your portfolio and don't follow the Oracle of Omaha. Don't try this at home. Running a concentrated portfolio is risky, and it should only be left to professionals like Warren Buffett. Before you go, let me remind you that your subscriptions to my channel really help support videos just like this one. If you've gained some value, which you probably have because you've made it this far, please go ahead and subscribe. It would really help and I would really appreciate it. Thank you so much for watching.